You look at your bank statement. The number is larger today than it was yesterday. You see a deposit. You see a balance. You feel a profound sense of security. You believe you have saved. You believe you are safe from the market. You are wrong. You are fixated on nominal value. You are completely ignoring purchasing power. The number on your screen is a psychological illusion. It is a carefully engineered metric designed to keep you sedated. The fiat system is not a vault. It is a melting ice cube. It was deliberately designed to be one. Central banks target a 2% annual inflation rate. They announce this policy publicly. They are explicitly telling you they intend to dilute the currency. The actual rate of debasement is often much higher. You leave $100,000 in a secure deposit. You do absolutely nothing. The digits remain perfectly intact. The math, however, is brutal and absolute. At a 4% real inflation rate, your purchasing power is halved in exactly 18 years. You took zero market risk. You experienced zero volatility. Yet you lost 50% of your wealth, a mathematical certainty. This is not a flaw in the system. This is the architecture. The system actively punishes the hoarding of currency. It mandates capital deployment. It forces you further out on the risk curve. If you sit still, the system extracts your past labor retroactively. The printing press runs. The money supply expands. Your fraction of the total pie shrinks by the hour. You think the bank is protecting your capital. The bank is lending your capital out at 8% and paying you nothing. They understand the velocity of money. You understand a false sense of stability. Currency is not a store of value. It is a temporary medium of exchange. To hold it indefinitely is to accept a guaranteed silent confiscation of your life's work. You trade your time for capital. The central bank slowly steals it back. You call it a savings account. The machine calls it cheap liquidity. You realize the savings account is a trap. You move your capital to an exchange. You open a charting terminal. You zoom in on the candlesticks. You see patterns, head and shoulders, double bottoms, bull flags. You believe the geometry of the past guarantees the trajectory of the future. You draw a diagonal line on a screen and believe you have discovered a map. You do not have a map. You are holding a target. You are suffering from the predictive delusion. You buy the breakout. You set a tight stop loss just below the support line. You followed the textbook perfectly, but the textbook was written for retail. The machine does not read candlestick patterns. The machine reads liquidity. Institutional algorithms do not care about your moving average. They care about the dense cluster of retail stop losses sitting exactly where the forum told you to place them. You need to understand the scale of the adversary. They cannot execute massive positions without moving the market. They need deep liquidity to enter and exit. You provide that liquidity. The algorithms actively hunt your safety nets. They push the price down through the support line. They trigger your stop loss. They force you to sell at the bottom. They use your automated panic to fill their buy orders without causing a price spike. Then the price reverses, leaving you behind. The reverse is also true. When the chart looks pristine, when the bullish breakout is confirmed and retail euphoria peaks, the volume surges. The algorithms use this engineered demand to quietly offload their positions onto you. You bought the breakout. They sold you the trap. You stare at the screen, wondering why the pattern failed. The pattern did not fail. It functioned exactly as intended. You think you are reading the chart. The machine is reading you. You set your alarm for 4:30 a.m. You work 60 hours a week. You believe the hustle is the answer. You believe trading your time for a larger salary is the path to wealth. You think the next promotion changes the math.
It will not. You are caught in the time for capital trap. Your income is strictly linear. The equation is bounded by physics. There are only 24 hours in a day. You can only bill a fraction of them. Every dollar you earn requires a direct expenditure of your biological energy. The state notices. Active labor is taxed at the highest possible marginal rate. You are the most heavily penalized participant in the global economy. Wealth is not generated by sweating. Wealth is generated by ownership. The people above you do not sell their time. They own the infrastructure. They hold equity. They control scalable systems. A system does not sleep. A software platform processes 10 million transactions while the founder is resting. A commercial real estate portfolio collects rent regardless of the landlord's daily schedule. Their capital compounds geometrically. It expands without their physical presence. Your capital compounds linearly, minus 40% for taxes, minus the cost of your survival. You grind harder. You optimize your morning routine. You read productivity manuals. You are optimizing the wrong variable. Hard work is a prerequisite for basic survival. It is not the engine of wealth. The engine is equity. As long as your income is mathematically tethered to your waking hours, you are simply a highly compensated gear in someone else's machine. You will eventually run out of time. The machine will not. You must detach your revenue from your labor. Until you do, you are not building wealth. You are just wearing yourself out.
You download the wallet. You write down the 12-word seed phrase. You disconnect from the banking grid. You believe you have seceded from the legacy financial system. You believe the code has made you sovereign. It is a digital mirage. You trade on a decentralized exchange. You swap a volatile token for a stable coin to lock in your profit. You feel secure. You do not ask what stabilizes the coin. You look beneath the protocol. The stablecoin is backed by United States Treasury bills. The bills are held in custody by a traditional Wall Street bank. The decentralized revolution is collateralized by the exact centralized fiat system you thought you escaped. You want to convert your cryptographic wealth into physical reality. You want to buy a house. You cannot pay the seller in code. You must use a centralized exchange. You submit your passport. You undergo anti-money laundering checks. The decentralized network ends at a centralized toll booth. The state still controls the exit. You believe Web3 distributes power to the users. You vote in a decentralized autonomous organization. You hold 10 governance tokens. You think your voice matters. You check the ledger. It is perfectly transparent. It shows you the truth. 3 venture capital firms in Silicon Valley hold 40% of the supply. They accumulated the tokens in closed-door pre-sales before you even knew the project existed. They dictate the protocol. They control the treasury. The infrastructure is distributed. The infrastructure is not. The architecture changed. The hierarchy did not. You did not leave the machine. You simply logged into a new interface funded by the same capital, tethered to the same fiat reserves, and controlled by the same architects. You cut up your credit cards. You double your mortgage payments. You celebrate the day your balance hits 0. You believe you are free. You have been taught that debt is a moral failing, a weight around your neck. You believe financial peace is the absence of leverage. You fundamentally misunderstand the instrument. You view debt as a burden because you borrow to consume.
The wealthy view debt as a shield. They borrow to retain ownership. They execute a strategy you were never taught. Buy, borrow, die. You look at a founder with $1 billion in equity. You assume they sell shares to fund their lifestyle. If they sell, they trigger a massive capital gains tax. They surrender 20% to the state. They lose the future compounding power of those shares. They do not sell. They never sell. Instead, they pledge the equity as collateral. They approach a private bank. They secure a pledged asset line of credit at 3% interest. The capital hits their account. It is not classified as income. It is a loan. It is entirely tax-free. They buy the estate. They fund the trust. The math works for them, not against them. The borrowed money costs 3%. The underlying asset continues to compound at 8%. They grow richer while living entirely on leverage. The end game is structural. They maintain the loan until death. Upon death, the assets pass to the heirs. The tax code grants a stepped-up cost basis. The decades of accumulated capital gains are wiped out instantly. The estate settles the debt. The government receives nothing. You spend your life working to eliminate debt. The architecture uses debt to eliminate taxes. You are playing a moral game. They are playing a mathematical one. You open your portfolio. You hold 4,000 stocks. You own a fraction of every sector. You sleep well. You have been taught the golden rule of modern portfolio theory. Diversification is the free lunch. You believe this broad allocation will make you wealthy. You are confusing survival with conquest. Diversification does not create massive wealth. It mathematically prevents it. You cap your downside by amputating your upside. You engineer an average return. You guarantee an average outcome. A 7% annual yield on a small capital base is a statistical rounding error. It takes 40 decades of disciplined waiting to generate what the architect extracts in a single quarter. Look at the origin of every massive fortune. No billionaire was minted by dollar-cost averaging into a broad equity index. Generational wealth is generated through deep, calculated concentration. You find an edge. You identify a structural asymmetry. You build a single company. You isolate a single asset class you understand completely. You place the capital on a specific coordinate. You focus violently. You accept the specific risk of ruin for the mathematical possibility of escape. Diversification is not the engine. It is the vault. You concentrate to create the wealth. Once the capital reaches a critical mass, once the number requires a family office to manage, then the rules change. Then you diversify. You spread the capital across commercial real estate, private credit, and sovereign debt. You diversify to ensure the wealth survives a macroeconomic shock. You diversify to preserve. You are applying the rules of preservation to the game of creation. You are playing defense before you have even acquired the asset. You are managing a fortune you do not possess yet. You will end up perfectly safe. You will never end up free.
You read the 10K.
You model the discounted cash flow. You listen to the earnings call. You highlight the footnotes. You believe the market rewards diligence. You believe intelligence generates alpha. You believe the playing field is level and the hardest worker wins. You are participating in a meritocracy that does not exist. True alpha is not found in public filings. By the time the data reaches your screen, the alpha has already been extracted. The market is not a contest of intelligence. It is a hierarchy of access. You are competing against structural asymmetry. You have a broadband connection. They have microwave towers transmitting trade data in microseconds to servers co-located directly inside the exchange. You read the news. They execute trades based on satellite imagery of retail parking lots and proprietary credit card data aggregated before the quarter even closes. You place a market order. Your zero-fee broker sells your order flow to a wholesale market maker. The market maker sees your trade before it clears. They step in front of the momentum. You are not trading against them. You are their product. You guess at regulatory shifts based on press conferences. They hire the former regulator to sit on their advisory board. They do not predict policy. They help draft it. They have proximity to the source. You have proximity to the echo. You are playing a game of fundamentals. They are playing a game of physics, information latency, and political leverage. You believe you can outsmart the machine with a spreadsheet and a late night. The machine does not outsmart you. It outpaces you. It outspends you. It out-accesses you. The alpha you were looking for was never on the page. You sit in a lecture hall. You read the textbook. You learn the efficient market hypothesis. You believe the market is a perfectly calibrated scale. You believe every price instantly reflects all available information, strictly tethered to cash flow and business fundamentals. You believe the system is rational. The system is not rational. The theory is obsolete. You look at the actual architecture of modern capital. The dominant force is not the fundamental analyst. It is passive flow. You contribute to your retirement account. The capital is automatically routed into a broad index fund. The fund does not read balance sheets. It does not calculate intrinsic value. It buys blindly, allocating capital based purely on market capitalization. If a company is massive, it automatically receives more of your capital. Its price rises simply because the blind flow requires it. The buying is structurally brainless. Then you add the machines. The algorithms do not care about a company's 10-year strategic vision. They trade on momentum. They detect a microscopic shift in price velocity and amplify it instantly. They buy because the price is rising. The buying pushes the price higher. It is a self-sustaining physics equation, completely divorced from the underlying business. You watch a stock lose 30% of its value in 45 minutes. The corporate factories did not burn down. The revenue did not evaporate. The cash flow remained identical. But a margin call triggered an automated liquidation, which triggered a stop loss, which triggered a retail panic. You spend hours calculating fair value. You are searching for gravity in a vacuum. The market is not a weighing machine. It is a liquidity engine driven by automated passive flows, behavioral contagion, and algorithmic momentum. It prices human panic perfectly. It prices fundamentals only by accident. You open an economics textbook. You read about the invisible hand. You believe asset prices are determined by pure supply and demand. You believe the market is a natural ecosystem where capital flows to the efficient. You believe in the free market. You are studying a ghost. The free market does not exist. It has been replaced by an administered system. Price discovery is an illusion. The invisible hand has been amputated. You watch a crisis hit the global economy. Supply chains fracture, revenues evaporate. The pure market dictates a catastrophic clearing. Asset prices should collapse. Insolvent corporations should burn. They do not burn. The central banks intervene. The Federal Reserve convenes. The Bank of Japan acts. They deploy systemic liquidity. Trillions of fiat engineered overnight, injected directly into the credit markets. They execute quantitative easing. They buy sovereign debt. They buy corporate bonds. They buy junk. They implement yield curve control. The central bank pins the interest rate to the floor. The bond market ceases to be a measure of risk. It becomes a managed utility. A forest requires fire to clear the deadwood. The system refuses to let the forest burn. It bails out the overleveraged. It protects the bloated. It socializes the systemic losses of the institutions while privatizing their gains. Capitalism without bankruptcy is an empty concept. You are analyzing supply and demand. You are not trading fundamental efficiency. You are analyzing intervention schedules. You are trading central bank psychology. You are front-running the inevitable bailout. The market is not free. It is a heavily guarded perimeter engineered to ensure the architecture never falls. You check the scoreboard. You count the zeros in the account. You believe the high score is the objective. You think accumulating massive amounts of currency is the final stage. You spend your life chasing the ledger. You are chasing a distraction. The currency is not the prize. It is merely the accounting system. It is a digital entry on a central bank server. The architects of the system do not hoard fiat. They use it to buy reality. You hoard the receipt. That is the ultimate redirection. They engineered a system to keep you focused on the scorecard while they quietly acquire the board. The actual end gain is not liquidity. It is hard power. You buy a larger house. They buy the municipal water utility that supplies it. You buy a luxury vehicle. They buy the data center that processes the telemetry of every car on the grid. You consume the media. They buy the algorithm that dictates human attention. Wealth at the highest level does not sit in a bank. It sits in structural control. Productive assets, global supply chains, institutional access. You lobby for a promotion. They fund the think tank that drafts the labor legislation. They convert fiat into leverage. They trade depreciating paper for permanent influence. Money is simply the tool used to extract power from those who think money is the goal. You win the game you were taught to play. You retire with a large number. You feel comfortable, but you are entirely dependent on their architecture. You look at the balance. You think you are free. You are simply the highest paid participant in a system you will never own. The market opens. The terminal blinks. The machine takes another step forward.